But what it does mean is that our baseline forecast sees hundreds of thousands of folks out of work relative to where we are today.
The U.S. economy has not had sustained growth at that level since the late 1990s.
That we think that the Federal Reserve will deliver on its promise of a soft landing. Hi, and welcome to the January edition of America's Credit Union's Economic Update, your monthly video review of economic developments and financial market trends that matter to your credit union. I'm with America's Credit Union's Legacy CUNA's Chief Economist, Mike Schenk, and I'm joined this month by Legacy NAFCU Chief Economist, Kurt Long, and our agenda today is pretty modest. We got together in the last couple of weeks. Our groups talked about the economy and our economic outlooks, and we put our heads together to come up with a blended forecast, a baseline forecast that incorporates the ideas, the thoughts, the outlooks of not only the Legacy CUNA team, but Legacy NAFCU's team as well. And we'd like to present that baseline forecast to you today. The really important thing to keep in mind is that this forecast really differs very little from the forecast that you've seen our respective organizations present in the recent past. The highlights, I think, that most important points are that this forecast really does represent the idea that we think that the Federal Reserve will deliver on its promise of a soft landing. That's great news, but we do also think that economic activity is going to slow down in the current year, and that could be a bit of a challenge for many. The other thing to keep in mind is that as we look forward, we do see the possibility of significant interruptions, disruptions, and volatility that will pose a challenge, not only from an economic and financial perspective, but a challenge for our members, for consumers generally, and by extension, for credit union operations. So without further ado, let's dive into the details. I'm going to turn it over to Kurt, and he's going to give you a general idea of what we think will be happening with overall economic activity in the year ahead. Kurt.
Yeah, thanks, Mike. I think as we look at GDP, and we just got the fourth quarter numbers, the year-end numbers for 2023, and then think ahead to 2024, we see that we come into the year with a lot of momentum, actually. So fourth quarter GDP surprised to the upside. We got economic growth over 3% for the fourth quarter, and that comes on the heels of a really strong third quarter GDP number of just shy of 5%. So you put those together, and in the second half of 2023, we had annualized growth of around 4%. Now, just for some context, the U.S. economy has not had sustained growth at that level since the late 1990s. So this is, a really strong growth period that we find ourselves in. I think as we, try and dissect those GDP numbers, the biggest reason that we've had such strong growth lately has been consumer spending. Of course, that's the biggest part of the economy. And so far, the consumer is still spending strong. I think as many of our viewers certainly know that personal savings rates are still quite low, and that means that households are still spending a pretty significant chunk of their income. So, I think a lot of people go into 2024 aware of some of the risks to the consumer. Will the consumer grow exhausted after having spent at such a pace? Might the resumption of student loan payments or some of the other stresses on households play a factor? That may be, but right at this moment, we don't see that. And actually, in December, we got the strongest spending numbers of the entire year. So there's actually some acceleration in terms of spending as we come into 2024. The other thing that stood out to me from the latest GDP numbers were the productivity numbers, labor productivity. So you can think of this as, we are seeing some slowdown in the labor market, and yet GDP growth is still quite, growing at a much faster pace. So producers are getting a lot more out of their labor pools than they have previous to that. So that's a really good sign for the economy. Suggests that we can grow in a sustainable way without seeing much inflationary pressures. A lot of people have different ideas about what is driving the improvements in labor productivity. I think from my own standpoint, my personal theory is that, we're coming off the heels of a period where there was a lot of job hopping. 2022, early 2023, a lot of people were changing jobs. And as we all know, your first weeks and months at a new job tend not to be very productive ones. But as that, dynamic has sort of settled down, people are growing into their roles. And I think that explains a lot of why we're seeing strong productivity growth. What that means going forward, though, is that as, this job hopping trend has subsided, I think we'll also probably see labor productivity subside as well as we get into 2024. And I think that matches up well with our forecast of still positive, but somewhat subdued economic growth over the rest of this year.
Yeah, and the important thing for people to remember is that economic growth is really driven in the U.S., by and large, driven by consumption activity, by consumers, our members, and their interactions in the marketplace. 70% overall, roughly, of economic activity has something to do with consumers. And part of the reason that the economy has performed better than we anticipated in 2023 really had a lot to do with the consistently strong job market and the employment situation in the United States, which, I think a lot of people expected to see a significant deterioration in the face of really strong, aggressive Fed rate hikes. But that just didn't happen. Overall, the economy added just south of 5 million jobs in 2022, and I think maybe a little bit north of 2.5 million jobs in 2023. That's pretty strong job growth, 2 consecutive years, although it does represent a slowdown that I think is indicative of what's happening with inflation as well. But a pretty strong job growth overall during the year. The unemployment rate ended the year at 3.7%. Our forecast calls for that rate to drift up to about 4.25% by the end of this year. And that's not a significant increase in the grand scheme of things, but what it does mean is that our baseline forecast sees hundreds of thousands of folks out of work relative to where we are today. And that's kind of a big deal, not simply for the 725 or 50,000 folks that represents, but for their families and for their communities. And so while we do think that the job market will remain strong enough overall for the economy to avoid recession, that does not necessarily mean that we don't think that there will be disruptions. There will be disruptions, and in some cases they'll be pretty significant. And so that does feed into the slower growth forecast that is part and parcel of this baseline. But it also, again, as I alluded to in my opening comments, also does feed into the idea that credit unions are perhaps not in for a rough ride, but credit unions will be challenged. Their members will be challenged if this baseline forecast actually does play out the way we expect it to.
Yeah, I think that's right, Mike. And, of course, the unemployment rate is really important to credit unions for a number of reasons. But I think, especially here lately, a lot of attention being paid to, loan performance and, credit unions thinking about how much do I have to reserve for potential loan losses. And so that unemployment rate figure is going to be, a critical one for them to watch. Now, obviously, we're talking about the economy. And, maybe the most watched metric over the last year and a half has been inflation. And, there we have a lot of progress to report. As I'm sure our viewers are aware, inflation has subsided considerably over the past 12 months. And we expect, as part of our forecast, for that to continue. So, just to set where we stand presently, as of the end of 2023, two significant measures of inflation. CPI inflation was just below 4%, and core PCE inflation, which is the measure that the Fed watches more closely on a year-over-year basis, is just under 3%. So, of course, that is still above what the Fed is targeting. They target a 2% inflation rate, but it is coming pretty quickly into the neighborhood of where they want to be. Now, as we think about, what is driving inflation, obviously, wage growth is a significant contributor. And there, too, we are seeing continued improvement. We just got numbers from the Bureau of Labor Statistics on the employment cost index. And of course, there's a lot of different ways to measure wage growth, but the ECI, the employment cost index, is sort of seen as the Cadillac version, the most, gives us the clearest view into how quickly wages are rising. And we got a below expectation number for the ECI in the fourth quarter. So, just continued good news on the wage growth front, and to the degree that it plays into inflation, I think we're still continuing to see, that downward trajectory in inflation. As we think ahead into how inflation might play out, I think the obvious question is, when might we reach the Fed's target? The Fed is targeting 2%. If you think about that on a year-over-year basis, well, if we continue to string together months like what we've been getting, and I'm thinking of especially about the last 6 months of 2023, we would be back at 2% by April. So a lot of ifs involved in that. It could be that we don't realize inflation, in the same way that we have towards the end of 2023. But again, that is just to, give our viewers a sense of, the fact that we are starting to get close to that point. So, I think there are some risks going forward. One obvious risk would be if, for whatever reason, consumers showed some renewed strength. And that's, even previous comments notwithstanding, the consumer is spending at a very strong pace. But if there were the reemergence of, inflationary factors due to consumer spending, that would be one risk. I think another risk could, maybe more likely risk could be geopolitical. It's always hard to predict these things, but that could be another source of inflationary pressures going forward. So, those things notwithstanding, though, we are on a very good path at the moment. And hopefully, and that's what America's Credit Union's forecast suggests, is that we'll be, closer to the neighborhood of 2%, at least by the end of the year.
Yeah, and the other aspect of what you were just talking about, all those risks and all that uncertainty that you just mentioned really does factor into what happens with market interest rates. And so our outlook on the 10-year Treasury is I have to say, probably the 10-year has been one of our least forecastable metrics in this forecast over the course of the last 10 years at least. And part of the reason for that is that the environment just has been generally an environment filled with uncertainty over most of that period of time. At the moment, the 10-year is yielding about 3.8, if I'm not mistaken. I looked earlier this morning, was in the neighborhood of 3.8%. I think our baseline forecast has the 10-year at 4.25 by the end of this year, so a bit of an upward movement. But in general, the movements that we've seen, again, a lot of volatility in that rate last year, the movements that we've seen generally tend to track with daily and weekly news in the financial markets. And so I guess a baseline, we're not expecting to see much movement, but a little bit of a drift upward on the 10-year. I think more importantly, what people are most interested in is what's happening with Fed funds. Will the Fed move? When and by how much? And you have some views on that, right, Kurt?
Yeah, that's right, Mike. I think as we think about the two in tandem, we've had this inverted yield curve for a year and a half now. And so that obviously creates stresses for all financial institutions, credit unions included. So, I think the hope this year is that we're going to see at least some normalization in the yield curve. We may not get it totally uninverted or reverted to a totally normal yield curve, but the America's Credit Union's forecast is that we'll see something more like what credit unions are accustomed to. So if the 10-year does go up to 4.25, our forecast at America's Credit Unions is that would leave a very small difference between the 10-year and the Fed funds rate. Now, our Fed funds rate forecast is calling for 3 to 4 rate cuts in 2024. And I think, that is very similar to what what markets are expecting right now. Markets are actually even a little bit more aggressive than what our forecast is in terms of anticipating rate cuts going forward. But I think, rate cuts are coming is probably the message that our members should take to heart. And the biggest reason for that is, of course, the inflation measure has come much closer in line with what the Fed is looking for. Now, a lot of interest right now in terms of the timing of rate cuts, and in particular the first rate cut. When is it going to come? And we actually just got a little bit of clarity on that question recently. So the FOMC had their January statement that they released. And of course, those statements carry very little in terms of practicable, actionable information in them. But following the release of the statement, Fed Chair Powell does a press conference, and there you do sometimes get important pieces of information. And that was the case this time as well. The question was put to him, in so many words, when are we going to get that first rate cut that you're anticipating? And his response was that our base case, that is the base case for the FOMC, is to not cut rates in March. And that was a little bit of a surprise to markets. I'm not sure if it was a surprise to us because we're a little bit more modest in our expectations for rate cuts this year. But, I think the base case for our viewers should probably be for May or even later. And it depends on, how the data comes in between now and then. But it looks like unless we get a significant really deterioration in the labor market, we're probably not going to get a March rate cut. And really, I think that's maybe the interesting thing here is previous to this, the Fed was acting solely based on what they were seeing on the inflation side of the ledger. But of course, they have two mandates. They have to be mindful of inflation and also the labor market. And so with inflation coming back more into scope, I think the attention is now sort of evenly divided between that and the labor market. And so, what are the risks to maybe the America's Credit Union's forecast? I think the principal one would be a larger rise in unemployment than what we are forecasting. And if that were to happen, the Fed would need to step in aggressively in terms of cutting rates. And that is where you would probably see the scenario for 5 or even 6 rate cuts in 2024. Now, I think, can't talk about rates without talking about maybe the most significant issue that has sort of beset the industry over the last year and a half as rates have been higher, and that's share growth. So, what does all of this mean for share growth for our members? And it's the view of the economists at America's Credit Unions that I think it's going to probably continue to be another somewhat difficult year liquidity-wise for credit unions in 2024. Maybe there will be some slight easing of conditions versus 2023. But I think in spite of the the rate cuts that we're anticipating, it's going to continue to still be a tough year for share growth. Of course, these things operate on somewhat of a lag. So just because the Fed is cuts rates whenever they do, it doesn't automatically relieve the pressure for credit unions and other depositories as well. But hopefully, it will provide a little bit of easing of the pressures.
Yeah, I mean, I think you hit the nail on the head in terms of the interaction, macroeconomic interactions and how they're going to affect credit unions. There will be significant challenges. That baseline forecast, I would say the headline on the baseline forecast is 2 years ago, credit unions collectively recorded bottom line results ROA of 90 basis points, very close to the long run average. In 2023, we think that's going to, when we get the data, that's going to be closer to 70 basis points. And our baseline forecast is calling for, I think, 50 basis points in 2024. So that represents a very significant decline overall in bottom line results and is a direct reflection of some of the challenges that many credit unions will be wrestling with, including liquidity challenges. It's interesting, I serve on the board of a fairly large credit union here in Madison, and I always look forward to my annual letter from the NCUA, which outlines supervisory priorities. And we've both looked at that, obviously. But what's shocking to me is when you look at that document of supervisory priorities, it's number one, I believe, credit risk, then interest rate risk, liquidity risk, cyber. You go through the first 5 points, and you think to yourself, well, what else is there to be concerned about? It's a relatively rosy macroeconomic forecast, but the headwinds are significant, and the red flags at the NCUA amongst supervisory authorities are being raised in pretty obvious ways. And so this will be a challenging year, and as I've always said, that's kind of a scary prospect for many of us. But it's also important to remember that, these are the times when credit unions really shine. We were, built in the midst of the Great Depression to help people get through tough times. And my bet is that we will continue behaving in that manner, no matter what comes in 2024.
Yeah, amen to that. That is a great note to wrap things up on. And, before we do wrap up, though, just a quick plug I'd like to issue for all the viewers, and that's we really hope that we see you in early March here in Washington, D.C. for America's Credit Unions Government Affairs Conference. Now, I know Mike is a veteran of that conference, but this will be my first GAC, so really excited about that, excited about connecting with so many of you. So with that, I think that does it for the January Economic Update video. Till next time, thanks for watching.